Hi, and welcome back. Today we're going to take a look at portfolio evaluation and performance attribution. This is the first part of a two-part video series. In the first part, we're going to take a look particularly at the performance attribution. In the second part, we'll take a look more at some of the risks that are involved and assessing portfolio risk. First off, we're going to take a look at 3 steps of the global performance evaluation. The first part is to calculate the rate of return by taking a look at the money-weighted and time-weighted rates of return and see how those are used. We'll take a look at the decomposition of our portfolio return into yields, capital gains in local currency, and then finally into the currency contribution. The third part is going to be looking at performance attribution in a multi-currency, multi-asset portfolio. The work that we're doing today follows the global performance evaluation tools that are largely specified through the CFA Association. There are 3 components that we're going to look at when we look at performance: performance measurements, performance attribution, and performance appraisal. Performance measurement is not something that we confuse with the accounting measurement of return. It's the performance evaluation components into which the returns are calculated over a particular measurement period for the overall portfolio and its segments. Performance attribution takes a look at performance evaluation, in which the performance is attributed to the investment decisions taken by the manager. That's largely the difference between the money-weighted and the time-weighted rates of return that we'll look at in a couple minutes. We'll also take a look at performance appraisal, and that's where we take a look at the particular components of that investment manager's skills and any of the risk adjustment measures that need to be applied. Essentially, we say that performance can be attributed to, well, first off, the selection of investments and the type of returns that they provide, either return through capital gains over the period or through yields, through interest and dividend payments. Composition of the portfolio is also another source of performance, choosing the right countries and markets, and so therefore we have to look at performance in that respect, and also things that happen to the currency over the period of time, if the currency appreciates or depreciates. The reason why we want to know specifically where the performance comes from is so that we can duplicate success. It's kind of like if a basketball coach is largely attributed with success because he has the tallest team in the league. And over time people say, right, having a tall basketball team is definitely going to be important. Well, perhaps it is. But if we use this spurious correlation, essentially equating height with success, we might miss out on something important. And perhaps the team has got, tall people, but they can all jump. Another coach tries to replicate the success by finding the tallest people in their university. And they end up with a very unsuccessful team because they're uncoordinated, they can't jump. Some of the actual success factors have been missed. So we want to avoid that spurious or ridiculous correlation that we often find by doing simple comparison by looking a little bit deeper. When we're calculating the rate of return, the simplest measure of rate of return is just to take a look at the change in the value of investment over time. So the simplest measure, and a simplistic measure, would be to say, let's take a look at the value at the end of the period, subtract the value at the beginning of the period, and divide that by the value at the beginning of the period. And that gives us a simple rate of return. We could also express that as a quotient by just saying the value at the end of the period divided by the beginning. There are 2 approaches to doing this. One would be to use the money-weighted return and the time-weighted return. And both of these methods are useful. They serve a different purpose. To start with, let's take a look at a portfolio and see exactly how each of these methods works. In our simple portfolio, with a single cash flow applied during the measurement period, the measurement period is going to be 1 year, and the formula we're going to use from the previous slide essentially says what's going to be the value of R. What's going to be our rate of return? To calculate that using each approach, we'll use the same data. The value of the portfolio at the beginning of the year, V sub 0, is equal to $10,000. There is one cash payment, cash withdrawal, on a particular day, 40 days into the year. And that cash withdrawal is going to be $650. The cash outflow takes place on day 40, and so T is equal to 40 divided by 365, or about 11% of the way through the year. The value on the day before the cash is withdrawn is $94.50, and the final value at the end of the year is $95.50. So with those basic bits of information, we're going to calculate the value of the value of our rate of return, using both the money-weighted and the time-weighted rates of return. If we just used the simplest measure of return and said what's the value at the end minus the value at the beginning, divided by that value at the beginning, or at the end of the year we have $95.50, we started off with 10 million divided by 10 million, it says that we have got minus 4.5%. Now that's the change in the capital value of the portfolio, but it completely ignored that withdrawal of $650. So it's clearly incorrect. We need to have a better method than that. The first approach would be to use the money-weighted return. It captures the rate of return on invested capital. Essentially, it is the internal rate of return to our project. It determines how much better off our client is, and that's one reason why it's calculated alongside the time-weighted rate of return. And in the United States, it's described as the dollar-weighted rate of return. And we know it also as the internal rate of return. The formula is pretty much one that we recognized before. We have the sum of all of the cash flows that are going to be received, and since by convention our cash flows are typically negative in the first period, negative of our cash flows discounted at 1 plus the rate of return at whatever time those returns are going to be achieved. And then at the very end we have got the total capital value, or the final value, V sub 1. All we have to do now is essentially put the numbers into the formula and solve for our rate of return. So with that basic information and the data that we had from the original case, and you recall that our portfolio started off with a value of, or has a value of 10 million, and that value is achieved by having a cash flow of 650,000 on day 40. That's why we've got the 40 divided by 365. And then our final cash flow, the final value for the portfolio at V1 is 95.50, again discounted at R. We can solve this using our calculator, and we find that the rate of return would be 2.12%. Another approach, an alternative approach, again still the money-weighted return, using the simple Dietz method, is to take the profit from the portfolio, or the total gains, divided by the average invested capital. So for this one, our profit is going to be the money at the end of the period minus the money at the beginning of the period, plus our cash flow, the 650, divided by 10,000 for the part at the beginning, minus, well, we've got 315 divided by 365 times 650. That gives us our average invested capital. And using the simple Dietz method, we would end up with a value of 2.12. Now, one of the issues with this is that it doesn't take into account the timing of the cash flows. And remember that $650 was achieved 40 days into the period, and the 9,550 was at the end. So the very important difference in timing might distort that number. But this is the simple Dietz method. The modified Dietz method is an alternative method that is used that we don't particularly cover in this course. Now, the money-weighted rate of return is definitely going to be of interest to the investor. That's the rate of return that they're going to achieve. But it doesn't tell us how well the fund manager is doing, because the fund manager can't control the timing of disbursements, timing of cash taken out of the fund. So for the fund manager, they're more interested in the time-weighted return. That's the performance per dollar invested, or per unit of base currency, whichever currency we're using. And it measures the performance of the manager independently of the cash flows in and out of the portfolio. And it's obtained by calculating the rate of return between each cash flow date and then linking these rates of return over the entire measurement period. It's the method that is required according to the CFA Global Investment Portfolio guidelines, the GIPS guidelines, and it's essentially a useful measure for comparing managers or comparing a manager against the benchmark. The formula is essentially this. We have the rate of return, or 1 plus the rate of return, is going to depend on the rate of return at the beginning of the period and the rate of return at the end of the period. And the rate of return at the beginning of the period is going to be essentially the value at the end divided by the value at the beginning. That's 1 plus R sub t. And the value at the end of the period is going to be V1 over V at the beginning plus the cash flow. So there's only one cash flow in this particular case, so we have a relatively simple calculation. We have that cash flow of $650 after 40 days. So in this case, our value for the first part, 1 plus R sub t, the value at time t, the day of the cash disbursement, is $94.50 over 10,000. And since that's a negative number, 1 plus that value is actually going to give us a negative rate of return of minus 5.5%. Then we have the value at time t plus 1. Well, that's the end of our period cash flows, and that's the value of the beginning plus the 650, and that comes out to about 8.5%. So R sub t, 1 minus 5.5% comes out to 0.945 times 1.08523 gives us our total money-weighted return of 2.554%. So our fund manager did better than the investor did using the money-weighted return, and that's because the fund manager doesn't take account of the cash outflows. Money-weighted return represents the average growth rate for all of the money invested. Time-weighted return represents the rate of growth for every dollar that's invested. Money-weighted return is sensitive to timings of the cash flows. Time-weighted return is not. Time-weighted return is preferable for evaluating the fund manager, who doesn't control the size or the timing of cash flows, and it's required by the Global Investment Performance Statement. Money-weighted return is more appropriate for circumstances where the manager can influence the timing of cash flows. For example, private equity funds that may have drawdown or takedown commitments for specific investments. Now, that's the first part of today's session, just taking a look at what we mean by return. And those are the two standard types of return, the time-weighted return, the money-weighted return. For the actual performance, we want to know a little bit about the attribution to which factor. What part of our activity generated the returns so that we can replicate success and avoid repeating failure. To conduct our detailed global portfolio evaluation, something that you're going to be doing in your final assignment, you need to be able to calculate for various segments the rate of return in local currency. And we start off with that. So essentially, our rate is going to equal the capital gains, P sub j, plus any kind of yield, interest, or dividends in percent. The basic data that we're going to start off with, and again, this comes from the Solnick textbook, about page 535. And here we've got a portfolio that's gained a total rate of return over the period of about 3.13%. Now, the company has achieved this by investing in two stocks, a Japanese stock, Sony, and a European stock, BMW. They bought 400 shares of Sony, 100 shares of BMW. The price in local currency, either yen or euro, was 10,000 yen worth of Japanese, 10,000 yen was the price in local currency for Sony, and that required a total investment of 4 million yen. So 10,000 per unit times 400 gives us 4 million. And at the end of the period, the price of the share had gone up to 11,000 yen, and so they had gained, well, about 4,400. 4,400,000, so they've got 400,000 essentially in a capital gain. BMW, they bought at 600 euro per share. That means the 100 shares had a local value, a value in euro of 60,000 euro. And in local currency, they ended up with 60,000 because there was no price appreciation in BMW. In our base currency, because we're assuming we're a US investor, the original value of our investment in Sony would be 40,000 US dollars, and in BMW would be 60,000 US dollars, for a total value of our portfolio of $100,000. We can see that we definitely gained some value in our Sony stock. It went up from 4 million yen to 4.4 million yen, and when we convert that back at the exchange rate at the end of the period, it means it's worth 41,905. And when we take a look at the value of our investment in BMW, it also has gone up. It's gone up to 61,224, so we have a total gain of $3,129. Now, we got there because, well, to start with, there was a change in the currency. The yen went from 100 to the US dollar to 105, so the yen appreciated. And we saw the euro depreciated against the dollar, going from 1 to 1 to 1 to 0.98 at the end of the period. So trying to figure out specifically how much of the performance can be put down to just the selection of securities, the change in the currencies, the change in the market indices, is something that we're going to need to look at. So why did this company gain so much? Well, that's what we're going to look at next. The first part is our currency contribution. Clearly, if you invest in something and the value of the currency in which you invest goes up, the appreciation is something that's going to add value to your investment. So we definitely do want to find stocks that we can invest in that are going to create value. So currency contribution is the difference between the portfolio return measured in base currency and the portfolio return that is measured in local currency. And here we've got an example using an investment originally in British pounds. For example, let's say that you bought some stock in British Airways, and you have invested £10,000 to buy the shares. Over the period, the price of your investment's gone up to £11,000, so you've been successful in local terms, in pound terms. Your original investment of £10,000 worth of stock at the original exchange rate on the bottom axis of 2 to 1 means that you had to put up 20,000 US dollars to get 10,000 pounds in your position. Of course, you've done well because the stock's gone up, but you've also done well because the British pound has gone up by 5%. It's gone up from £2 to the US dollar to 2.10. So what looked like a gain from $20,000 to $22,000 because of the increase has gone up by more than $3,000 to the total value that we see up at this point in the corner. Of course, that can work the opposite way. So we want to know specifically not just what happened to the selection, but what happened to the currency. How much was down to gains and how much was down to the wisdom of your choice of stock. The portfolio total return then, measured in local currency, can be decomposed as our capital gain in local currency, plus the yield, interest and dividends, plus any kind of movement that we have in the spot rate of the currency. To perform our calculation, it's useful to break down the return into segments by asset type and currency. For example, one segment can be domestic stocks, domestic bonds, foreign stocks, foreign bonds, and so on. When we say homogeneous, we mean that these bonds have got common characteristics that aren't shared between classes of assets. The total return decomposition formula, one of those scary looking formulas with lots of terms, can actually be broken down quite simply, in this case, into three parts. We say that our total return is going to depend on our choice of weights, the W in the portfolio, and it's going to depend on things like the capital gains. So the first part of our investment, this part here, essentially says our return is going to depend on the weight times the percentage of capital gains from our selection in the portfolio. The second term is going to be the weight times the yield times the dividend or the interest for each of the selections in our portfolio. And then the third part is going to be the weight times the change in currency, again for each of the investments in our portfolio. Now, in the example that we've already started to look at, you can see that we have an investment in two country portfolios, a Japanese portfolio and a European portfolio. We have our Sony stock and we've got our BMW stock. Our portfolio is made up of 40% Sony and 60% of BMW, so that's our total portfolio. The return from our investment in US dollars in Sony was 4.76%. Return from our investment in BMW was 2%. So 40% times 4.76 and 60% times 2.04 gives us our total portfolio return of 3.13%. Now remember, there's a difference or a movement in the currency. So how much of the gain was a result of currency and our choice of yen investments versus euro investments? Well, Sony's rate of return in yen was 10%. And so we'd say that the total contribution of currency would be 10% less the actual dollar returns. So we ended up with a currency contribution of 4.76 minus 10% would give us the 5.24% net loss because of the currency contribution. So yes, Sony did extremely well, but the dollar didn't do so well. So part of what we gained in yen, we lost due to the exchange rate. We lost about 5.25%. In the case of the euro, well, there was no return or no change in the local currency. It started off at 100, it finished at 100. So the currency contribution was essentially the rate of return on our stock was 0, and there was a slight movement in the euro. So we ended up gaining a little bit because of the currency contribution. Again, the weight times the currency contribution, and the sum of those two weighted amount values turns out to minus a little bit less than a percent of loss, actually, from our currency contribution. Our choice of markets was also important. The Japanese index improved by 5%, and the European index lost by 5%. Now you can see that we had a 10% gain in local currency in that particular industry. And if we subtract from that the movement in the market, essentially we did 5% better than the index. So our security selection produced a 5% better rate of return than, in this case, the Nikkei index. And for our investment in BMW, well, the market fell by 5%. We had a 0% rate of return, and so the security selection result was 5%. And here the weights times the percentages come out to be the same, so we did 5% better because of security selection. So our performance then can result from any of the following investment decisions. What are we going to buy? Which stocks are we going to buy? Which bonds are we going to buy? In fact, we can even break that down by class of assets. How well did we do within a class? We could also say that our performance depends on our allocation into different currencies. Another thing that we haven't quite looked at yet is market timing, our movement from one class of assets into another, and so the variation in the weights over time. And then finally, the security selection. Security selection is determined by identifying the local market rate of return for various types of investments. And then part of the return measures that we're looking at are measuring the performance that would have been achieved had you invested in a local index instead of local securities. So did we outperform the Nikkei when we bought Sony? Well, yes, we did. We actually did better than the Nikkei index, so we outperformed in terms of security selection. If we'd bought an underperforming stock, we'd say that we underperformed the index, and so our performance wasn't good in market terms, even if we gained in currency terms. An example here, I would say that if we're looking at security returns, we can look at the following bits of index information. The first part takes a look at the effect of, or the movement in the index. So how much did the index go up? So here we've broken that out of our total gain, and we've said our overall security performance depends on the performance of the index plus the amount of gain that we had by selection. And here P is the percentage of gain on our investment, or that particular segment of the investment, and I is the index value, the local rate of return in the index. And of course, as before, exactly as before, we still have the performance from yield, dividends and interest, and the performance from the currency selection. So we've taken the previous information, we've just added another bit of information. So now our overall asset allocation, the word contribution in this context means the performance relative to the benchmark. So how well did we do by selecting Sony, or instead of selecting Sony, maybe we chose Panasonic, and so on. Our relative performance, how well we did relative to the index, can be broken down to the market allocation that's different from the index. So perhaps instead of buying the whole market, we decided to go overweight or more focused on particular stocks. Currency allocation, that's different from the index. And then finally, did we buy the best stocks? So if we take a look at the performance so far, here's our portfolio on the top. This is what we said we were going to buy into. We bought Sony, we bought BMW. The benchmark looks at all of the Japanese stocks and all of the European stocks. And if you said that we have a benchmark portfolio, which is 50-50 weighted, we decided to be different by going a little bit heavier into European stocks. So we said we're going to go 60% into European, and we're only going to focus on one company, that's BMW. We're going to go underweight on Japanese, and we're only going to buy Sony. The rate of return to our portfolio, as we saw earlier, the rate of return in US dollars to our investment in Sony was 4.76. To BMW, it was 2.04. The weights times the return gave us our overall portfolio return. We did better than the benchmark because they lost. So we had an actual return of about 4.86% better than the index. We significantly outperformed. The rate of return in local currency, well, the currencies moved during this period, and they moved in Japanese yen by 5%, and they also moved in euro. Our rate of return in local currency was 4%. Their rate of return was 0%. Whatever they gained by investing in the Japanese market, they lost by investing in the European market in local currency. Currency contribution was the other factor, and we have the same exchange rates that are going to be shared between the two portfolios. But by over-contributing, or by being overweight in this particular class, they gained from the currency contribution, or we gained from the currency contribution, more than we lost by underinvesting or being underweight in Japanese. So our currency contribution was 0.87 versus the benchmark portfolio, which was 0.53. So to sum up, we could say that the benchmark rate of return against which we're comparing ourselves was 1.53. If we did exactly what the benchmark said, we would have lost 1.53%. The amount of contribution that we got by allocating to the right market, well, we actually underperformed in that because we saw that the European market would have been the better choice, and we were underweight in the European market. Currency allocation, we had a positive contribution from that, but the real reason that we did better than the benchmark was because we had the wisdom to choose Sony instead of BMW, and that gave us a 5% contribution. So the sum of all of these attribution factors essentially said our portfolio return was 3.13%. So That's going to give us a start. Those are some of the main factors. There's one other factor that we hadn't mentioned yet, and that's about market timing. Market timing essentially says that we can make a contribution by varying the weights, varying the construction of our portfolio over time. We'll take a look at a little bit more of that in a second. There's a little bit more too that I want to say about currency management. You don't just have to take the currencies that are given. There are a couple of ways that you can adjust the impact of currency on your portfolio. And the first is the natural approach, where we just change our portfolio to take advantage of the expected movements in currencies. One of the reasons why we've spent a lot of time this semester taking a look at the expected movements in currency. So we can change the weighting in our portfolio to reflect our expectations of movements in currencies and deviate from the international benchmark against which we're comparing ourselves. We can also use a derivative strategy. Perhaps we can use spot rates, or we can use futures or forwards to control our exchange rate exposure. The overall currency component of the portfolio is essentially the sum of the currency contribution that we get from our benchmark, the currency allocation contribution that we get by changing the variation, and any return that we get from the hedges that we use in futures, forwards, or options or swaps. When we're talking about that benchmark, one of the best known benchmarks is the MSCI index. If you're an American company and you're looking for a comparison of your domestic investments versus the rest of the world, the best example is the EAFE index. And so the EAFE index is something created by Morgan Stanley. It's essentially means Europe, Asia, and Far East. Is also described as non-North American. And so if we wanted to compare ourselves to this index, that's some of the information we'd use. We also see there are proprietary sources of information, companies that will provide comparisons. And here's an example taken from the Solnick textbook, but apparently provided by a source called Intersect Research. It's quite a standard presentation of this kind of information. You can see in each of these bar charts the information is provided with a median, first quartile, third quartile, top of the range, and bottom of the range bit of data. And across the bottom we have information about the company's own results. And you can see the dot in this case suggests that the company did very well overall. Their total return was well into the first quartile, or the best quartile, with 17.3. And the average for the index, or the benchmark in this case, the EAFE index provided by MSCI, was in the first quartile. How did we achieve this return? Well, clearly it was mostly about market allocation. We obviously went overweight in markets that were very different from the MSCI. And that put us into the top quartile with a rate of return of about 7.7%. In terms of currency, we underperformed with a rate of, well, with a return of -2%. So we did not do as well as some of the others in our benchmark group. And we did a little bit better in terms of stock selection. So for this particular fund and these particular fund managers, their performance was largely down to being overweight in the right places, going into the markets that were the strongest. So far, we've had an introduction to the idea of asset allocation. We've seen that stock selection is clearly going to be part of our success story or a reason for our failure. But it also comes down to other things. Investing in the right currencies, investing in the right markets, having the right weighting of allocation in each of these categories. And also something that we didn't talk a lot about, timing. The decision to shift from one asset class to another over a period of time. Well, that's the return side. In the next video, we'll take a look at how risk is going to be measured and attributed as well. Stick around, we'll come to that video next.